A new Goldman Sachs survey reveals majority of individuals limited their spending to save money leading up to this holiday season while still remaining optimistic on their financial situations in the new year despite the uncertain economic environment. To break down all of the details, we've got Joe Duran, who is the Goldman Sachs Personal Financial Management Head. Joe, great to speak with you, man, and we appreciate the time today. First and foremost, when you were looking through some of this data, what really stuck out to you in terms of the broader trend that you're seeing from consumers right now?
Well, two things. First of all, that no matter what generation you're in, we're all aware that we're in adverse times. And so, as you mentioned, 76% of people have been saving in advance of the holidays, which might suggest why we're seeing people maybe not spending as much. The economy's slowing down a little. So I think inflation is helping people to be responsible. And we're also seeing going forward that about 78% of people are expecting to be a little bit more conservative in their spending in the coming year. So I think what you're seeing is that the Fed's goal of slowing things down, along with the fact that inflation has spooked people, that everyone's basically battening down the hatches a little bit in the appropriate way to ensure that they have a good holiday season, so people want to have fun. We did not ask the question, are you saving to go on vacation? Are you going to saving to go buy goods? But I think the economy is kind of telling us that. The stock market's kind of telling us that the people are spending on experiences.
When we were looking through some of the consumer sentiment data that came out earlier today, it said that consumers had been weighed down by rising borrowing costs, declining asset values, weakening labor market expectations. If there's an outsized weight that consumers are giving to one of those factors, which do you believe it would be, and what were the surveys telling you?
Well, definitely inflation. I'll tell you one of the interesting stats that came from this data that I think you'll find interesting. Out of all the generations, when you look forward at are people's economic situation going to be better next year? If you're young, 77% of Gen Z expect next year their financial situation to be better. But if you're a baby boomer in your 60s or 70s, only 28% of people expect their situation to be better next year. What does that suggest? That if you're making money, you expect to get some increase in your pay. But if you've stopped working, as many baby boomers have, or you're near the end of working, you actually get a bigger bite from inflation. So inflation is a two-edged sword. If you're earning money, then you expect your comp to go up as well, and we've seen that. And if you're older and on your retirement, then inflation is really not a pleasant experience because it affects your savings, your ability to live your life. So everyone's being appropriately conservative. But the impact and the expectations going forward is very much affected by how old you are. And we see again in the middle, Gen X, our generation in the 40s and 50s, not you, but me and my colleagues, that they're about 58% expecting it to be worse next year. So again, I think what you're seeing is the younger you are, the more optimistic you are. The more you've experienced inflation, as people in the baby boom generation are, who were here in the 70s, the more conservative they tend to be.
I can confirm, Joe, all of us on set are about 30 years old. But let me ask you this. We're hearing a lot of consumers starting to trade down. Those higher income consumers, are you seeing that in your data?
We didn't break out. We broke out. It was mostly age dependent. But I think you can see when you go out, it's very interesting that some luxury brands are doing well. And we've heard this anecdotally that people tend to be saving their spending for things that are more important, of higher quality, no matter where you are in the age spectrum. So your day-to-day goods, you want to spend as little as possible. And when you're buying something that you're saving, as we saw 78% of people save for, they want it to be something special.
Joe, Julie here, fellow Gen Xer. We got a geriatric millennial next to me, by the way, and and a Gen Zer, I think, on set.
Oh, no,
or young millennial.
Millennial
Anyway,
proper.
But Joe, you referred to people who are closer to retirement right now, or even people who are in retirement. And man, this has got to be a tough time to be on the precipice, right, with the market performance we've seen over the last year. So for those folks, what are you telling them right now?
Well, it's not just the market. Actually, we've had the most unusual situation over a 10-month period. Only 3% of the time do bonds and stocks both go down. So literally since the 1930s, we haven't seen what we've experienced in the past year, which is that bonds, if you had fixed income, you went down in some cases double digits, as well as equity. So what does that mean? It means that people who were really conservative, who had all their money in fixed income, have seen their portfolio actually decline while their stocks have gone down as well. So that's a very, very tough situation to be in. Now, once you've been through that decline, the worst thing you can do is then make changes to reflect what you should have been in a year ago, because it's too late. The market has already priced that in. So we're telling people is, look, you are where you are. Your adjustments should not be made on your investments. They should be made on your life choices. So what do I mean by that? I mean that if you're retired, if you've experienced, say, a 20% decline on your entire portfolio, which would be not unusual, then you can make that up by simply spending less, about 8% less for about 3 years. And what you might find is the market will recover in that 3-year period, and then you can go back to your original spending. If you're not yet retired, you can offset a 20% decline in most financial plans by waiting 18 months to retire. That alone will offset the decline you've had. And over that time frame, hopefully the market will recover. And so what we tell people is, although it might not feel good in your portfolio, your actions and reactions should be things you can control that affect and allow you to make the prudent long-term decision. The biggest mistake people make is they let their emotions drive their investment decisions. And we all want to sell when the market's gone down, even though it's the worst thing you can do. We all want to buy when the market's gone up, even though that's also not good for you. And so what you need to do is make choices that allow you to stay with a long-term financial plan and a long-term investment strategy.
Joe, I am going to replay this video for anybody who asks me for financial tips when we're at the Thanksgiving Day table. Joe, appreciate the time here and happy
Enjoy
Thanksgiving.
Turkey Day, everyone.
Yes, same to you.